Since our last trade update in May, markets have continued to recover from the March lows that we saw. This has really been driven by falling inflation rates all around the world and a number of economies starting to emerge from the lockdowns, which saw a number of businesses ceasing trading. These positive outcomes have been very well received by investors and has helped push many equity markets back close to the levels that we saw at the start of 2020. There has been some markets which have actually risen above these levels. For instance, in the US equity market is now above its 2020 open, while there's other sectors like US IT and healthcare and consumer staples, which have also moved to levels above their 2020 levels. At the same time, we've begun to see the impacts of the shutdown on the global economy. In some instances, we've seen unemployment rise to levels that we haven't seen since World War II. While closer to home, we've just heard from our Treasurer suggesting that we're already in the midst of a recession, the first time in 30 years. At a company level, we've seen many companies withdraw their guidance while also slashing dividends. And this really means that the picture is very unclear as to where profits and payouts may go from here. Developments in financial markets and the real economy therefore look to be telling us two very different things. Consistent with our process, we're not trying to predict what happens next or where markets might move from here. We remain firmly focused on positioning the portfolios to those assets which we think are going to deliver us the best risk-adjusted returns. And that's very important in a very uncertain world. We continue to see great long-term opportunities in sectors like energy and financials, having fallen so far. But there's other opportunities which have moved higher, and this has reduced the margin in safety invest. And this is a crucial element when future developments are so uncertain. As a consequence, we've looked to reduce some of the growth assets in the portfolios we added to in March. A number of these longer term holdings have delivered very strong returns in the short term. And a number of them have delivered over 40%. So we consider it prudent to take some profits on these holdings. We've also looked to take some profits on our position in consumer staples, which has held up very well over the course of 2020 so far, but it also had a very strong 2019. The money which has been raised from these sell downs has been mainly applied to cash, but also some defensive assets like Australian bonds. We think bolstering the defensive holdings of the portfolio at this point in time is considered prudent, particularly given the optimistic outlook which many investors have now factored into their outlook. And we think in this environment, they should be better protected. In short, the outlook remains very uncertain, and the potential outcomes for a post-COVID-19 world are very wide-ranging in our opinion. We don't know what's going to happen from here. In this environment, we want the portfolio to be as robust as possible. And we think the changes that we're making to the portfolio should benefit them in this regard, particularly over the longer term. That said, we think the portfolios are the best position they have been for many years, having added material growth exposure to them, which we think will aid them in delivering on their long-term return objectives. Some of these opportunities have already played out, and we've taken profits on these in our May and June trades, but we'll continue to monitor the portfolios closely, ensure that we continue to position the portfolio to those opportunities which we think are going to give the best long-term return objectives for the portfolio.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.